Welcome back to another Market Insight call. We took a week off. We got snowed out, different set design, different people. Aaron's not here. Joined this week by Dan Goeddel. He's the COO and a partner. And Christina Shockley. She's our Chief Planning Officer and also a partner. We did a little bit different this week. We each took a topic. I took the top 20-25 themes revisited. Market's having a little bit of trouble here. We'll revisit those. Dan took this time is different, or maybe it's not different. We'll find out. And Christina's going to do a bunch on taxes. So let's get into it. So the big themes we wanted to hit on from the market side is the technical patterns have held really nicely the last couple of years. So I did want to hit on a quick technical pattern. And of course, the biggest headlines are tariffs. We'll spend a lot of time on tariffs. They're too long, didn't watch video. Description that we would give on tariffs is the market's dealt with them before in 2018. We'll deal with them again. It may be a little rocky, but the market will get through it. We'll look at some earnings growth, and we'll close on some other items with deal making. So the January effect is this idea that the market goes up in January. There's a bunch of reasons that could be. We don't need to spend time looking at it, but it is important for technical traders. They even come back to it throughout the year, even though today market may even be flat to where it was in January. Your favorite line is, the market hasn't seen these prices in 30 days.
You know, it's been about that long since we've seen these prices, Chris.
Yeah. And yet there is a lot of panic in the market, even though it's only been a few weeks since we've seen it. But I did just want to call out a couple things on the chart and why it is a good setup for the market. January was up 2%, even though we've given a lot of that back. On average, it does lead to 12.3% calendar year, which is more than the average on a normal year, which I guess you'd expect because you're spotted a strong month. You'd tend to keep going higher. And the probability of an up year goes up to 84% versus the average 76%. I was actually, at the end of January, was with a group of technicians that look at only this stuff. They won't look at earnings. And this was important to them. So that's one thing we wanted to call that they will call back to something like this because it does tend to lead to a trend in the markets. The next one, the most important one, is tariffs. And the question everyone asks, and what I think they incorrectly answer on TV, even today, if this has been talked about for a couple months, is, are tariffs inflationary? And I hate just reading stuff off, but I'm going to do it.
Chris, what's the definition of inflation?
Inflation, this is from the Fed, so we'll take this in two different ways. Inflation is an ongoing increase in the general price level of goods and services in the economy over time. So are tariffs inflationary? Tariffs are a one-time price, tax paid by the importer, usually gets passed on. Now we can talk about other things of why it may not get passed on, and that's too much inside baseball. But the main thing is that I do not find tariffs to be inflationary, and a lot of people get this wrong. And it is because it's an increase in a specific good, and it's one time. So it's not going to continue. We can look at it from the Fed's perspective. So if inflation goes up, they want to fight it. They want to, maybe they have to increase rates, which is bad for the economy. They're going to likely, and you hear them talking, ignore this because it doesn't meet their definition of inflation. The other part of tariffs, which is what I don't like about tariffs, is they can reduce consumption, reduce GDP. And that's what the market gets scared about. The market's not going to be scared about the inflation that comes from it. They're going to be scared that there's going to be a decrease in consumption and a decrease in GDP.
Well, that's what I'm hearing from clients is fear. You know, the uncertainty tax around tariffs and which tariffs are just temporary, which tariffs are going to last a long time. That uncertainty is scaring people. I mean, think about the whipsaw from Obama to Trump to Biden back to Trump. If you're trying to make long-term capital investments and you're working internationally, that's not a great climate. It really isn't. And I think what we need to distinguish between is really what is a short-term tariff that's aimed at really changing the negotiation playing field. So I think the best example is Canada and Mexico, right? So we'll hit that in a moment. And then what's really going to be lasting? And I think that best example is what's going on with China. So let's focus on short term.
Right.
So I think a lot of people were very afraid and the market sold off and there were jitters when tariffs were announced over the weekend about Mexico and Canada. I think those are just the opening shots in a negotiation aimed at really non-financial, non-economic ends. So what were the goals of these tariffs? I think it's to stop illegal immigration at the border and to stop the flow of fentanyl, which has killed over 300,000 Americans in the past 5 years. So, Chris, what happened after those were announced?
Pretty quick, they were able to pull them back for the short period of time. We'll actually find out in the next 10 days or so if that's true. And so that your theory will be really put to the test. But that's my whole part of why I don't like them. And I want to hear your long-term view on them as well, is because you're putting the market through this. That the market has to try to read through, is this going to be here? I can't make an investment based on this, right? Especially if it's just a bargaining chip, which some people have said. I have that on a slide we'll talk about.
I think Trump has to be careful with how hard he pushes this as a negotiating tool. I mean, if you go back to 2018, if you remember, there was almost a bear market. The market entered correction territory and went all the way down to negative 19%. So I think there's a lot of game to be played. We'll see in the next 10 days. But I think those tariffs are very short term, as Trump is really resetting geopolitics and our relationships across the globe. I think there are tariffs that have very long-term implications. Let's look at what he did with China. So Chinese imports, steel and aluminum, those tariffs were put on. And guess what? The Biden administration actually kept them on. They're still on today. So Trump has said we're going to increase tariffs more on China. That's really aimed, I think, at generating revenue, at reshoring capabilities here at the United States. And I think those have long-lasting implications. Now, Europe is where I'm uncertain. Is it in the short-term bucket? Is it in the long-term bucket? And I think that uncertainty is going to weigh heavy on markets.
Yeah, and the Chinese ones were highly expected, right? We knew that. That was spent on the campaign trail. He called them out personally. He did not call out Canada and Mexico personally throughout the year. So those were different. They were, when you look at what, I even had it on the previous slide, Howard Lutnick said, of course it's a bargaining chip, don't tariff stuff you don't make. And then they proceeded to make announcements about tariffing things that we don't make. And that's what the market gets afraid of, because if that does roll on, and I'm not going to fall for a trap you set later in this, which is trying to read into it too much and trying to sound too smart by looking at things. You'll see headlines trying to predict exactly the GDP decline from a tariff. No one knows. And when we actually look at it long term, we'll talk about other policies from the administration. To us, this is really the big negative. There are other policies that are actually long term bullish for the economy, but all else equal, if you put through a tariff that does not lead to more domestic investment, which there's a great history of tariffs not leading to more domestic investment, market's not going to like that in the short term or the medium term. It's going to take time to get past that. There are offsets. Of course, the tariff has a decrease in GDP on the consumption, but if you have more investment, which is the goal, that's a good thing. And if we get through that, and I know that's what you were saying long term, if we're able to do that, or reduce retaliatory tariffs. What's going on there?
Yeah, I mean, I think most of the tariffs are more bark than bite. And over the long run, very little of this is going to matter to the true long-term investor.
And to be clear on going back to our definition of what a tariff is, when we say we're going to throw on a retaliatory tariff, we're saying we're going to tax domestically our people for goods produced elsewhere because you're taxing your people for goods produced here. So we're just going to throw a tax on us and hopefully they reduce their tax. Now, that could happen. If they reduce their tariff when we reduce ours, that's a good thing. You get there. But that's so much uncertainty, because if that doesn't happen, we just have higher tariffs. We haven't changed our income taxes, so taxes went up on our citizens.
Yeah, and I think the mandate is really for Trump to cut prices, right? So it's going to be interesting to see how far and how aggressive he really pushes this if it starts to have those implications. And I know one of the big risks of the market is that inflation does heat up and the consumer does get squeezed.
The biggest question here is, what does that short to medium term tariff look like for consumers?
That's the problem. We don't know. And that's why people want, and I know you were talking about reconciliation and legislation. It's a good thing that these tariffs are not in some law that can quickly change.
I want to come back to that later.
but this is all based on, I had to download Truth Social to follow this stuff. I never thought I'd have a Truth Social account because it takes a couple hours to then get it onto X to follow the announcement of tariffs. Yeah. And that just leads to a lot of uncertainty for the market. Now, I do think what you've described is the end result, and we're going to get there, but it's going to put the market through a lot in the short term. That's what we're already seeing.
Well, I'm curious. I've been hearing a lot of comments from clients about DOGE and about the cost cutting. And I'm curious, Christina, what are you hearing from clients, and kind of what do we think the implication for the market's going to be?
Yeah, I mean, from a personal perspective, I see it every day. We work with families, and ultimately, those who are potentially laid off are impacting our clients, whether it's directly by existing positions being either taking the voluntary buyout or getting laid off, or it's indirectly where it's just something that they're seeing every day. So it weighs on me that this is something that could have an economic impact or a potential economic positivity, but it's a negative impact to everyone that we see personally.
Let me give the economic take on that overall, which is, so the government can fund itself through taxes, future taxes, deficit spending, or through inflation if the Federal Reserve's buying the debt as well, where they find a way to print money. And reducing government spending by reducing jobs in even the medium term. The short term, of course, it's bad because you have uncertainty with those people who are still part in consuming. But even in the medium term, as those jobs start to be picked up in the private sector, and that can be a discussion of how long does that take? It could take 2 years. But as you're reducing deficit, reducing government spending towards the private sector, it's actually really good, medium and long term, really bullish actually for stocks.
But what about the government agencies that we rely on so explicitly? So the IRS, we're coming up into tax season. We have a contact that we just met this past week that was trying to push through a cancer screening device, and that's going to truly impact people and individuals and families and their health. And they're waiting on government agency approval, and now that government agency approval is delayed. What's the break-even point between how much cutting is too much?
I think that's a really tough question. So Doge is led by probably the best entrepreneur of our era, Elon Musk. And if you've read his biography that Walter Isaacson wrote, one of his core principles is cut and delete so much of the process and parts that you have to add 10% back because it was essential. So what's going to happen when he does that to the federal government? Have we encountered that in our lifetime? Is there a precedent to run on?
No, but I just saw an article just today that it says government agencies are having to hire people back. So maybe that's it.
But I think back to the uncertainty and the fear kind of weighing over markets, this is a piece of it. I mean, a big question I have is, say they lay off 500, 600, 700,000 people. Sure, they're going to be paid through September, but what if there's not an opportunity to hire them in the private sector by then, right? So could they be more productive in the private sector? Potentially, but will they be given that opportunity? I think that's, again, people don't know how it's going to play out from here.
Just leads to the uncertainty, but that's why I don't even go, most people that follow economics will say long term it's good. I do give it short term in the 1 to 2 year as we do reduce some of those jobs and stuff, because they are going to be picked up in the private sector. It may not be in a quick way. It may take a couple years, but it is going to happen over time. There's always job mismatches. We've been adding 100,000, 200,000 jobs a month on net. Some of that was government in the past, but not a lot was state and local government too. So if we are able to add government jobs with mismatches, you can get there pretty quickly.
Yeah, and I think I'm excited that something is being done to address the long-term debt issue. It seems like every president tries to outdo the last in deficit spending and setting new horrible records. That adds up. The famous Hemingway quote, how do you go bankrupt? Slowly, then suddenly all at once. And that's kind of the path of our country. So something has to be done. So the stated goals are, the intent is to balance the budget by the end of 2026. I'm very skeptical of that. I would love to hear what you guys think. Is that even in the realm of possibility?
You know my section and how it's been quoted as the largest tax cut in history. So we'll get to that in a few minutes. But I do think, that's a big part of it.
Wow. Well, let's just close out tariffs while we're here and then move on. So I did want to just show a slide from tariffs. It's complicated looking, but it just shows why does the market get nervous when tariffs are announced? Well, they always have, for reasons I've talked about. And on average, the market is down around 1.25% on tariff announcements. And actually what it shows is there's a rally in bonds that does happen too, which goes against when inflation goes up, bonds go down. But when inflation's going down or there's a scare in the economy, which is what we're seeing now, you can see rates go down, which means bond prices are increasing. And that's generally what you see with tariffs, because there is this growth fear that there is going to be a decrease in consumption. So what we're seeing in the market is normal. It's what you'd expect with all the uncertainty. We had an uncertainty slide, which I really wanted to show for two reasons. One is policy. When you're looking at a survey right now, it's heavily driven by policy and politics. And that's what a lot of things we're seeing. The inflation expectations, if you look at a market-derived number, it's only up a little bit on inflation. But if you do a survey, Democrats are saying inflation is going to be 4 to 5%, which would be high. It could happen. If we see massive spikes in energy, that they could be right. But we're not seeing that. We're seeing energy prices coming down, which would keep those numbers. Those would be too high.
Yeah, I think in terms of politics, our approach as a firm is we need to be agnostic and we need to be impartial practitioners. So we need to very much understand, what are the Republican policies, what are the Democrat policies, and the impact on markets. Our obligation is to protect families and grow wealth for families. So when I look at kind of everything going on, I like to remind people what happens in your house is much more important than what happens in the White House. And I think another critical piece is companies are still trying to beat earnings. Earnings calls are still happening every quarter. That is really what's going to drive the long-term wealth building, the growth of purchasing power, which is the whole reason we do investments. So Chris, maybe could you kind of reorient us on where are earnings right now and what is the big picture in terms of the real economy and how the market's reacting?
I love that quote about your house and the White House, and we used it in our blog the night before politics, or for the election. And the business example that we used was Alphabet, Google, parent company. I think both parties hate them equally. Yet in the long term, they've been able to add growth, add earnings, and continue to reward shareholders, even though they have that policy uncertainty with both parties. When we look at it as a whole, expectations for the year, we have 4 lines here on these bars. S&P 500 on the right, that's large cap, where the expectations for the year about 15%. The green bar is the small cap, the 600. That is actually higher expectations. Then we move internationally, where expectations are much lower. So far in the year, returns in international stocks have been higher. It's not a growth story. It's the idea that these stocks are maybe just too cheap relative to what's being priced in, something that maybe we don't necessarily believe will last long term. It's probably its own podcast on its own, so I don't think we have time to hit that. But the expectations for growth is high. And when we look at what was actually delivered on the last quarter, they delivered. The expectations, I circled it in, put a square in green. The expectations for the quarter, previously we were looking at calendar year, to close out the year was about 12%, 11.9. And the S&P delivered 16.9%. So significant earnings growth last quarter. It was a really strong year when they basically only have 2 more earnings reports to get through. That's NVIDIA and Broadcom. By the time this comes out, we will have heard from NVIDIA. But the main takeaway was overall, the S&P 500 U.S. stocks had a really strong quarter, and the market was rewarding that until we just got into all these political headlines that have been short-term negatives.
So talk to me about earnings in the U.S. and earnings internationally, especially Europe. Now, international is making a comeback right now. It's been a whole 2 months. You've been underweight international for years, if not a decade. I know you and Aaron have continually said the U.S. is the place to be. Earnings growth is more robust. These companies are more valuable. They do deserve a premium relative to Europe and the rest of the international community. So can you share just what does the earnings, foreign and domestic, really look like at this point?
I think the simplest model, and it's flawed, price to earnings ratio, because it's only 1 year of earnings. When you own a stock, you own it for a lot longer than 1 year, and it discounted back to today. That trend, I'll throw the chart up, is this is the percentage of a discount that you see in international relative to the U.S. It hit its absolute low last quarter. And so what we're seeing is, well, a lot of what we're saying is starting to get priced in. We've started underweighting the space at the far left part of this chart in 2015, if not even before then. And so we've been correct, and you've seen the appreciation. As that line's going down, U.S. stocks are outperforming generally. And there are massive swings in that number when it starts to bottom out over the last few years. We've seen that. And right now we're just in the middle of one of those where yes, they deliver on earnings growth in the 7, 8, could even be 9%, when our earnings are doubling that. But if the price is so low that that's actually good, you're outperforming, you're going to see small moves in international stocks. So we haven't seen it for where we're saying this time's different, we want to start allocating here, but eventually that likely will happen.
And that'd be great for diversification.
It is. It's
So
great time to be globally diversified. The one part we would say it's not a great time to be globally diversified is China. Don't have any slides pulled in here. It is it looks like a massive short squeeze where there's massive spikes in the price, 30% declines, then moving. It looks like gambling to us, and we've said that for a long time, that Chinese stocks are essentially gambling. They don't have strong financials to know you're actually earning what they say they're earning. So we are going to be underweight China for the long term. Do not want to allocate there. Europe is different. There are opportunities in Europe, and we are using a couple managers who really specialize in this space. Tom Buckingham is one. We met with him recently, and he's finding good opportunities to find some really undervalued European stocks. It's not something we're going to significantly overweight, but it's something we might start adding a little bit to.
So Chris, you mentioned NVIDIA has their earnings report. It's probably the most important earnings call of the week, if not the quarter. You know, if they beat, the AI boom continues, right? And if they don't, or if it's way worse than what it's expecting, could we have our first market correction since AI is really taken off?
I think people want to stay invested, and what we're seeing is people are investing globally. I think it's going to move the market, certainly, but if there's a miss, I think we see international stocks significantly outperform. A lot less technology. The international index is around 10% technology versus 30 here. So NVIDIA will bring down the tech-specific market, which generally means the other areas will outperform. Those other areas are in the international index much more than here. So I think we'll see a big shift internationally. Just the shift continue there if that does happen. But we're still positioned mostly domestic with domestic overweights, but it could continue pushing us international as well.
So do you know who doesn't care about this week's earnings call? Warren Buffett.
Well, that is certainly true. And he released his 2024 annual letter to his shareholders. He did not mention that position. But he did mention one thing that really jumped out at me, and that was his massive $334 billion cash position. So what did I immediately think about? What does he know that everyone else doesn't, right? So I start to feel the fear, and I go down the rabbit hole of, oh my gosh, are we on the precipice of a down market? I'm human. We all go through this. And one thing I go back to is the timeless wisdom of, okay, well, what do bear markets actually look like? But before we go deep on that, Chris, what's your take on Warren Buffett? I would love the unfiltered take here.
I obviously love Warren Buffett, but when it comes to looking at his portfolio, he's done a great piece of what we would tell everyone, our high net worth investors, to do. He's got a little bit of cash, he's got some fixed income, has some public stocks, has a lot of private assets too, and he's got a massive piece of cash right now, that you've referenced. And that tends to be a fun headline and a fun talking point. And it depends who you listen to, because you talk to the fear mongers, he knows there's something coming, there's going to be a pullback, and he's going to buy. Or you talk to the Tom Lees, who would really bullish, long-term bullish, like we are. This is future buying. You're sitting on a bunch of cash. He said in that letter that he wants long-term to have a lot of equities, yet he's been a net seller. So eventually it will come in. So you can really spin that however you want. But we can look back at his portfolio and have a slide, not super scientific, but it is just showing that there's been cash drags in his portfolio, as he's not a great market timer. He's been selling for over a year now, trimming back some positions. But what he does do in the long term really well, he sticks to a strategy. Now most likely will never buy NVIDIA. And he's in his mid-90s. He may not live to see the next significant pullback to get all this cash put to work. But eventually, they will start buying securities that match their themes, which are just deep value. They like to buy high profitability companies, usually with a valuation screen, which worked really well in the 70s until 2000. And he did time Apple really well. That was the one tech stock that he did go for. So I do think he's run a great portfolio, but don't think his cash signals anything specifically.
Well, that's good. Thank you. I can sleep tonight. But, one thing I heard from a client last week was the famous line,
"This time is different."
This time is different. And it's been a while since I've heard this, but I'll acknowledge I was kind of feeling, is this time different? So, Chris, let's go back to the history of bear markets, and let's go back 25 years. So let's look at the formal 4 we've had. So let's go back to March of 2000. We have the dot-com bubble.
And so this is a drawdown slide, so it's not going to show the upsides. It's going to show once you go down, and then once you recover your high, you've hit that high mark again.
Perfect. So the decline in the dot-com bubble, and the dot-com bubble actually has a narrative that's rhyming a lot with today between the internet and the rise of AI. So that decline was 45%. And it's scary when you're down that much. Chris, who was the famous investor that right around the trough of the bear market of the dot-com bubble?
Bill Gross, he was running a lot of money at the time, and he called the bottom of the bear market almost to the month, with one exception. He said it was going to continue going down another 30%, and it put the absolute bottom in that month.
But it speaks to even the best investors of all time don't know how far it's going to fall. Is it going to stop at 30? Is it going to stop at 40? Is it going to go down 50, 60? And that fear starts to take hold, right? So it took 7 years to recover from that drawdown. Can you imagine that if we had a bear market start today and we didn't recover these levels for the next 7 years? Wow. So let's fast forward next. So we recovered May of 2007. We're fully there. Well, what happened in the fall of 2007?
Housing crisis.
The housing crisis, the great financial crisis. The drawdown was even worse and more painful, down 53%. But the recovery was not 7 years, it was 5.4 years. So there was certainly elements of that time where people said this time is different, that, wow, that was a scary narrative, right? But we recovered, and 5.4 years later, we're at the all-time high again. So it took a while. After that, we have the ZIRP era of zero interest rates. We almost had 2011, 2018 we talked about earlier with tariffs. So we had a couple fear moments where it went down negative 19%. Didn't quite go to that bear market negative 20%. And then you have COVID, the black swan, right? So we moved into our offices when, Christina?
It was in, November of 2019, but into these offices in March of 2020.
And we sent everybody home after 1 week in our brand new space. And that time definitely felt different, right? Yeah. Separated from all of our loved ones. Now, the market went down 34% and went peak to trough in a month. Now, I'm going to give some credit to Chris and Aaron. So right before the Fed announced unlimited support to markets and started buying fixed income, Chris and Aaron actually called for a V-shaped recovery. So we'll link to that in the show notes. And congratulations, this is 5 years since we've done this podcast. But what a scary moment, right, where people are losing loved ones. There's basically martial laws declared. It was a wild period of time, and there were so many reasons to sell. And we called clients, and we had so many thoughtful conversations to stay invested. But certainly, this time is different. We heard it a lot then, didn't we?
Yeah.
And in that pullback is also probably the Fed has got a little confidence in the measures they brought out when that happened, right? And when the next time we see that happening, they're probably going to do something similar. They think it worked. Yes, they had the inflation. They're going to get past it here in the next couple years. I don't think we're going back to 9% inflation. So the way they would see it is they think that was successful. And we could have a whole different discussion that wouldn't be considered success the way we would measure it, but they're going to probably do something similar again. It gets us back to our long-term theme of why we like stocks for the long run. It's because it gets you that long-term inflation hedge, and because the next big pullback is probably going to be met with those same tools.
Yep. So, and then let's fast forward to the next crisis. So 2022, inflation is out of control. The Fed is behind the curve on raising rates. The Fed is now increasing interest rates at the fastest clip in history. And the market has a drawdown of negative 25% right after we've recovered from COVID. And it took 23 months to recover from that, back to December of 2023 before all-time highs. And since then, we've been blessed with the AI boom. A great run last year. So far, we're off to a good start. There's a little bit of fear. But let's look at the big picture. You know, these dips, 3 per year, minus 5% drawdowns, right? A market correction every year.
Well, you know
What's John's favorite line?
You know the
Christina?
age-old joke that you can expect a correction as often as your birthday.
That's right, and we're overdue. We have not had one since the AI boom, and then bear markets every 3 years. And if you look back in the past 5 years, we've had 2. So I looked back and I just said, okay, I know we're skewed by the extremes, but just give me the average of these past 4 bear markets over the past 25 years. Peak to trough, 1.2 years. Peak to peak, 3.7 years, and an average decline of negative 39%. Ow. A lot of advisors are telling their clients, ride the roller coaster, right? I mean, how many blog posts, LinkedIn posts have we seen from advisors really putting content out there to placate their clients? So that simply is not excellence. So our perspective as a firm is, if you're looking for in the next 5 years, expect a bear market. Certainly expect many market corrections and 5% dips. But what should you do? The first thing you should do is create a financial plan and a cash flow analysis that says, I'm going to take out from my portfolio, I need how much cash over the next 2 years, how much over the next 5, 10, and the rest of my life. And you need to have enough cash. We hold it in a hub account full of cash alternatives, and treasuries for clients, to where it's safe, to where that short term, we are always prepared with that insulation. Next, we have bonds. Most clients have 5 to 10 years worth of their spending and fixed income that performs well in these long periods of drawdowns. And then you have equities that are truly long term. Our goal is to make sure clients never have to sell any of their equities low. Now, we cannot guarantee that, but that is the best you can do. And you really have to work with a firm that marries your plan to your portfolio and have them both in harmony to achieve that outcome. So I like to tell the story of one of my favorite clients who retired in February of 2020. So done earning income, fully retired, settling in, and the pandemic starts. And the panic call was, oh my gosh, do I have to beg for my job back? Do I need to start a little consulting practice? What should I be doing? And you know what we said? We got you. We've got 2 years of cash. We have plenty of bonds. We're not going to sell anything low. If anything, we're going to be looking for opportunities. And we're going to call you when we think it's an opportunity to rebalance to our target allocation of equities, or maybe even add more than the target. So that's the confidence we want to give to the families we serve. But Christina, I'd love to hear your perspective working with clients. How do we help them in these moments proactively prepare instead of just riding the roller coaster?
Absolutely, Dan. When we're looking at another age-old saying that we constantly look at, it's not what you make on cash that matters. It's what cash allows you to make on everything else.
Well, the best strategy is personal. It's the one that allows you as a unique human being to not sell at the bottom and to earn that long-term equity premium.
Each one of those pullbacks will be a little bit different, but I know you always will end with the same thing, is there's going to be a point where we're calling clients saying, now's time to add risk.
And in the meantime, don't panic every time the market drops 1%, 2%, or 3%. Go enjoy your life and focus on what really matters. We've got the portfolios.
We talked a lot about policy. We did not get the tax yet. Christina, why don't you close us out?
Yeah, so one of the biggest questions that we're hearing from clients is, what is the future of tax legislation? This is an extremely timely discussion, given that the 2017 Tax Cuts and Jobs Act are set to expire in the end of 2025, going into 2026. So before diving into the proposed changes, I want to take a moment to look back at where tax rates were before the Tax Cuts and Jobs Act. So actually, this slide that we're pulling up on the screen was a part of the Market Insight broadcast we hosted a few months ago when we were analyzing the potential tax policies under the different administration options. Now, looking at current congressional discussions, we can see that nearly all of our provisions are actively on the table for debate. So going through each one of these sections, you have the top rate, you have individual tax rates, you have the SALT, state and local taxes, you have the estate planning exemption, the state tax exemption, the child tax credit, the standard deduction, capital gains rates, and the corporate tax rates. That's a ton of potential options that we are looking at as what's been called broadly as the largest tax cut in history.
Well, I'm really excited about the impact on Social Security. So one thing I feel very strongly about is our clients paying to Social Security over their whole lifetime. And they would do a lot better off investing those dollars in the market. And they're not allowed to do so. But sure enough, they pay in their whole life. You can go log in and see how much you paid by year since you started earning and see the whole history. But then when you go to take it out, it's taxed again. It's taxable income.
Who would have thought, right? I mean, it's incredible that we've gone this far and haven't had this proposed just yet. So this is actually one of my favorite provisions that's in this upcoming tax bill that we're looking at and how this is going to be potentially passed by budget reconciliation. Because the thought process is with the no tax on tips, no tax on overtime pay, and potentially no tax on Social Security, those are kind of all lumped together. Now, I like to look at Social Security specifically because you already paid tax on that, right? It's income that you earned, like you just said, that has been taxed. It's put into this bucket for future taxpayers. And then when it comes out, if you are above specific income bracket levels, which have not been adjusted for inflation historically, that's incredible. To think about almost every other tax bracket that we're in, adjust for inflation year over year. The provisional tax on Social Security, the income tax brackets that are associated with the Social Security tax have not been adjusted for inflation. So whether or not you adjust the brackets for inflation or whether or not you take the tax off completely, I think both are very credible. In terms of potentials that we may see coming into this tax bill. I personally believe we're going to try to take it all off the table and it may have to come back in. I actually see that as a higher option or a higher likelihood than having that inflationary adjusted because the brackets are relatively small. And if you remember the specifics with regards to Social Security tax, it's that 50% up to a smaller bracket, depending upon if you're married, filing jointly, or if you're single. Let's use $44,000 as an example for married, filing jointly. That means 50% of your Social Security income is subject to tax. Once you go over that amount, then it could be up to 85% of your income. So thank you to the government. We still have that 15%, no matter what, that is still not subject to tax, but I think that could be a big benefit for a lot of our retirees.
And what do you think the biggest impact of the law will be on business owners?
Yeah, I think when you look at one of the options that we have the corporate rate reduction. This is a lower corporate tax from 21 to 15%. Now, we've heard Donald Trump say this is specific for Made in America goods. So I think that there's going to be some caveats to how this is going to be worded in the bill that are going to be who it's applicable for and who it's not. Because service providers, for example, is that technically a Made in America good? We'll see. I know as a current service provider, I would love to see this impact. But this is important because this is potentially moving the corporate tax rate from 21% to 15%. So when we're looking at that potential cut, that now means that many companies might actually be in a lower tax bracket than where they could as a pass-through entity, whether it be through S corporations or sole proprietorships. So we're going to see partnerships as an example as well. So we're going to see a lot of just overall conversations with regards to how that bill comes out. One of the other aspects that I think that is incredibly important, and I think the biggest impact that we have, is that the extension of the 2017 Tax Cuts and Jobs Act. So most people, you've heard them describe this as current law or current policy. We have to make sure we realize that these increases in the standard deduction, the increases in individual tax brackets, the increase in the top rate, that is all current policy. That is not current law. The number one question that so many people are having is what's going to happen with the 2017 Tax Cuts and Jobs Act. As I mentioned at the very beginning, these provisions are set to expire next year. So that means if nothing else is done, there is supposed to be an increase in individual tax brackets. There is supposed to be an increase in that top tax bracket. There is supposed to be an increase, or there was an increase in the standard deduction, so there would be a decrease at that point. So that's a big impact if this bill and that provision isn't provided to go further. And remember, in 2017, that was passed off of a reconciliation bill. So the fact that we're now having to potentially pass a reconciliation bill that expands or continues a reconciliation bill, this is going to be extremely difficult for Congress.
Well, and what's the implication for the deficit and the goals to really balance the budget by the end of 2026? Wow. One
of the other provisions that was put in, and I believe Donald Trump ran on this as part of his overall campaign, was the SALT deduction cap. So one of the big changes as part of the budget reconciliation back in 2017 is that we capped state and local taxes at $10,000 on your individual federal tax returns. when we're looking at that cap for these higher state income tax states like New York, New Jersey, California, that's a big decrease in incentive for them. That was an impact that I think that was part of this negotiation process. And now Donald Trump and Congress in this bill is looking at potentially putting erasing that cap or changing that cap or having changes to that overall deduction. So that's a piece of this bill that we're still not necessarily sure how it's going to play out, but it's a big piece because that's going to be an additional impact to those high income earners in those high state tax.
Well, I hope they can pass it soon so that we can start planning with clients to take advantage for their personal situations.
Absolutely.
A lot of good things there. And we started with some of the negatives in the market. We said that was really the big negative from the administration. A lot of good things you shared that will help support the long-term moves in the market as well. Way over time. We'll be back next month with Aaron. I think he's back. These guys might start their own podcast by then too. So see you next time.